Hey, Andrew Woodward here from The Investor's Way, and welcome to Woody's Weekly Wisdom, episode number 60. And I'm doing something a little bit different today because we're going to have a look at two pieces of information because of the impact of one against the other, which is often, a dilemma when I'm looking at what to talk about each week. When it comes to which news article to choose, there's often articles that are saying the complete opposite of each other. But in this case, there's a couple here that I really want to highlight and talk about in terms of what's probably going to be the big financial news over the next couple of weeks. So before I dive into the two articles, if you're watching this on YouTube, hit the little bell up there to get notified when we put out new videos. Hit the subscribe button, and so you'll get notified as soon as they go up on the YouTube site. And if you're watching on Facebook or LinkedIn, do us a favor, hit the like, comment and share buttons. Leave us a comment. Let us know what you think. And we'd love to hear your thoughts on our weekly wisdom videos. So I've just got a little frog in my throat, but let me clear that. Sorry about that. But let's have a look at these two major talking points or articles for this week. So we've got this grim outlook on mortgage repayments, and then we've got unemployment rate rises to 4.1%. So let's go and have a look at the grim outlook first. And you can see what they do with the mortgage, with the headlines. So the original headline was a grim outlook, and then we come across here and the outlook for this, or the headline for the story is something different. But it basically says, mortgage arrears are steadily increasing since late 2022. And so I won't get too hung up in the article itself, but generally speaking, what we're seeing and what this talks about is that the number of people who are falling into arrears with their mortgage is rising and has been rising since 2022. And you can see that it's a result, obviously, of the rise in interest rates, which is highlighted here. They're 2.52 up to 4.98 and now into 6.27 in terms of average rate. So it's quite a significant rise in rates. And what that's effectively done for a lot of people is that it has eroded their advanced payments, or their gap between what they were supposed to pay and what they now having to pay. So people were getting ahead, paying extra installments or extra amounts, and as the rates have risen, the gap between what they were supposed to pay and what they were paying has been eroded, and now they're having to keep up with these rising rates, which is it's hurting. And with a large, and it talks about here about a large percentage of people in the 80% loan to valuation ratio, obviously those higher rates are having a bigger impact on those borrowers. And so, it just continues to talk about, how households are struggling with this higher interest rate environment. And I think a little bit further down, it starts to talk about the impact of inflation and what this means for what might happen at the next interest rate board meeting of the Reserve Bank. And it's kind of saying, if the market does this, it'll go one way. If the market goes this, it'll go another way. No rocket science to that. But with banks expecting housing loan arrears to continue to rise, there's a whole lot of fear in the upper echelons of the financial markets about what impact that's going to have on the Australian economy, because as more people go into arrears, more defaults happen, and therefore more forced sales happen, and it leads to a bit of a self-fulfilling prophecy, just like rising interest rates have in terms of inflation. If we see people starting to have to go into arrears and banks having to force sales of properties, that's going to lead to some prices, or certainly any pressure on prices rising in the housing market, to disappear, because people will just be selling it, banks will be selling it whatever they can get in order to recover their money. They're not so fussed about any capital gain that you might have paid or be hoping to achieve from the sale. So it talks here about, like I said, with the upcoming Reserve Board meeting on August 6th and what might happen with inflation. With interest rates. And again, there's fears that the March quarter CPI data showed that inflation was still rising, and it's being very, very belligerent and won't fall at the rate that they want, and the interest rate rises are not causing the result that they want to see. And so, again, like I said, a lot of fear about what might happen with interest rates on August the 6th. And if we've got this pressure building with people falling behind on mortgages and potentially the cliff that potentially exposes, then it was handy to be able to show you this other article, and I'll try my best to prevent this video from starting, which is always difficult. But this article says basically, oops, get out of the way. The ABS releases latest labour force figures, and unemployment has risen to 4.1%. And this first section here basically says that analysts are largely agreed on what that means for the next interest rate decision. So if we scroll down, and what does it mean? Well, it's basically saying that almost every analyst believes that with unemployment rising, there's obviously no pressure on the wages side of things, and therefore they all believe that the Reserve Bank will be forced to put interest rates on hold. So that's I guess the good news, in that the previous article is talking about we're heading towards this potential cliff of people who can't fund their mortgages and forced sales and all those types of things, and another interest rate rise would just make that even worse. And then we get this new piece of data that comes along and says, well, the unemployment rate has risen, and so there's less people in the market, and that's going to slow the economy and spending and all these types of things. And so as a result, there's less pressure on the RBA to increase rates. So it's still all about inflation and what are they going to do if inflation continues to remain sticky. But I think we're likely to see that when that inflation data comes out, that this whole position could change if it doesn't do what we want it to do. But that comes out on the 31st of July, as referenced here. But most people, as you can see, again, the analysts are not expecting a rise in inflation, and with unemployment rising, that means there is less people in jobs, obviously, and therefore able to spend, and that should slow the spending down and result in a softer inflation landing for the month, that is, or the quarter. So 31 July, keep an eye, pardon me, not doing very well with the voice today, but 31st of July, obviously an important date when it comes to that inflation data. And if those employment results keep rising, and then we see more and more people falling behind in their mortgages, then we're going to see a much softer economy and a very different approach from the Reserve Bank in terms of what they do next. And so keep an eye out for those type of things, and keep an understanding of how this might impact your scenario. And I remain, whilst not confident, but at least optimistic that the next move for interest rates will be down. And for those people who are looking to manage their monthly household money, a decrease, obviously, in interest rates is what you're looking for to take a little bit of pressure off that management of your household income and expenses. And I think, as I said, I'm optimistic that the data is now starting to line up that the prolonged higher interest rates, and let's face it, these interest rates are not historically high, they're probably at historical norm levels, but because they rose so rapidly, it's hurt people, and I think we're starting to see in the economic data that hurt is starting to come through. So employment rising, so businesses are finding it hard. People are falling behind on their mortgages because all of that goodwill that they generated through COVID, where their expenditure was lower, so they were able to really top up on their mortgage. All of that good good work has been to an extent eroded in the rapid rise of interest rates, and so people are now starting to fall behind, and that's going to slow things down quite rapidly if that doesn't come under some form of control. And I think the best way that they can control that is not to keep rising rates, and to even start talking a little bit more about the likelihood of a reduction in rates. I don't believe that's going to necessarily fuel people to go out and spend willy-nilly, because if you've got all these other factors going on in the backgrounds, like rising unemployment and like the stress on mortgage payments, people aren't going to go just willy-nilly spending because the Reserve Bank suddenly says the next move might be down. Sure, there are people in other positions who might be able to do that, but on balance, I think we're starting to see the impact of all of these things starting to really show up in the data for maybe the first time in the last 6 to 12 months. We're starting to see some real soft numbers that are putting us on the precipice of a potential downturn, and the Reserve Bank and the government are going to be very keen to make sure that doesn't continue to play out, and do their best to try and keep that under some form of control. So we'll see what happens come August, and also with the inflation numbers come July. But I thought it was a good opportunity to just show you that you can get two pieces of data that line up sometimes and produce a handy opportunity when it comes to talking about the economy and how that might impact your money management and ultimately your investing. And obviously, if we start to see lots of forced sales in the property market, that becomes an opportunity for those people who can take advantage of it, and it becomes a real unfortunate scenario for those people caught up in having to sell their property in a market where it's being done under stress. So hopefully that was helpful. You got some useful information from that. Leave us a comment down below. Let me know what you thought. And as I said at the start, hit those subscribe buttons if you're watching on YouTube, and leave us a comment and a like and a share so that we can spread the news to more and more people, so that they can apply this to their own financial scenario and have better money outcomes in the long term, which is what this is all about, helping people have better money outcomes. So that's Woody's Weekly Wisdom, episode number 60. You have a great week, and I'll see you again next week. Cheers.